Welcome to the InterMarket Analysis video update. This is a video that I do every week where we look at a number of different things. I look at the valuation of the S&P 500 on a historical basis, as well as looking forward out into the future. I also do a pretty extensive look at growth versus value, and we also look at other markets outside of the S&P and other sectors, and we do ratio studies to see how are different areas of the market performing right now. This is being prepared for Monday, December 9th. Before I start in the video, please listen while I tell you about the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. If you're interested, there's a link below this video that will take you to the website or to a video. Also, here's an email address if you want to contact me with any questions or maybe set up a time to talk about things. Also, this is the intermarket analysis video. This is just one of the weekly videos that I do. The real hub of the foundational knowledge that I try to pass on to you is done in the daily videos. So feel free to check those out and see if they'll be of use to you. All right, the first area that we look at is S&P 500 valuation. First, we look historically, and we have a thing called the PE ratio, the price to earnings ratio, and that's based around a static scale that doesn't change. We have a PE of 10, 15, and 20. Well, you can see where the S&P is in relation to the PE ratio of 20. So we're quite overvalued on a historical basis. Then going back to 1980, different events that have happened and what the valuations were at that time, you'll notice that we can spend years being overvalued when looking backwards at earnings. And that's very common. So we don't use this like a timing mechanism. We use this more just for informational purposes. Then there's a variation of this that Robert Shiller came up with called the Shiller PE ratio. You may hear it referred to as PE 10 or CAPE, CAPE. And according to how he calculates things, we're coming in at 38.8. Well, that's a pretty high reading, and we're actually getting above the reading that we saw back in 2021. To give it a little more perspective, the median and the mean are between 16 and 17, but we've been seeing this now for a couple of years, and we're seeing very high readings over here that have lasted a number of years as well. So again, we just use this for informational purposes. And then the market uses forward-looking PE ratios, and this is put out by Edward Yardeni. And there's four different areas that we look at on this chart. First are the Mega Cap 8 or the Magnificent 7, whatever you want to call them. That's the purple or pink line that you see here. We're coming in at 29.4, which is really over that 20 level. We're also above 20 with the S&P forward-looking PE ratio coming in at 22.1. And we're even going up here and getting above that 15 level where we've been at for quite a while with the mid caps and the small caps. Both of them are coming in right now at 17.1. So even looking out into the future, the market is considered to be expensive when you look just at the S&P 500. It's a little more fairly priced when you look at the mid caps and the small caps, and it's very overvalued when you look at the mega cap 8. All right, then we look at growth versus value. First of all, I look at a chart of growth all by itself, and it is really doing well these days. Where value is still doing good, it's still in an uptrend, but we're seeing it pulling back as we're seeing growth going up. And that's what we want to see in a more positive environment. Where we get some real insight is when we do ratios between growth and value, and I have a number of different charts that go through that. Up on top is a growth to value ratio showing how growth is outperforming and really doing quite well recently. The bottom area is an inverse showing how value is underperforming growth and really starting to underperform. Then we look at some indexes, also confirming that growth is outperforming value here with a longer look at this chart. This is also a longer chart looking at the inverse showing how value is underperforming growth. Another couple of ETFs also show that growth is outperforming value, and this also shows how value is underperforming growth. So we're getting confirmation across different indexes and different time frames, also seeing how growth is outperforming here with this index with the shorter term chart. Then we look at a growth ETF and a value ETF, and we had been spending a lot of time down in the rainbow. Now we're starting to break up out of that. So this is just showing how growth is also outperforming value. This is an inverse of that same thing, also confirming that value is underperforming growth. Then we break it out and look at the small caps, and we're seeing a real improvement here. Now, this is the time of year when small caps tend to do better. We call it the Santa Claus rally or the January effect. About halfway through December, going into January is when the small caps typically perform well. But you can see up here, this is the small cap index. We shot up and we're actually pulling back now. That's not real positive for the index itself, but you can see that growth is really starting to outperform value enough to where if this continues and we're above these two lines, the red line and the blue line, we will see a golden cross here with this ratio pretty soon. We're also seeing a real improvement with the mid caps. Even though the mid cap index has been coming down lately and not really going anywhere, we're seeing a real improvement with the growth to value ratio, and we should see a golden cross here pretty soon as well. We are holding up in an uptrend here when we look at S&P growth to value, and that's what we want to see for the indexes to keep going up. Then we keep an eye on inflation. First of all, we look at a monthly chart of the CRB index, which are commodities. That's pretty much been going sideways now for the last, well, almost 2 years. And then we look at a ratio between inflation and deflation, a longer term monthly chart where this continues to decline, and there's a moving average on here as well that is also declining. So longer term, at least when you base it around commodities, inflation is not really a problem. Here's a daily chart of the CRB index where we're just kind of chopping sideways right now. We're actually a little bit in a downtrend right here. Then we also look at inflation by looking at a thing called the Baltic Dry Index, which is how much does it cost to ship products from point A to point B in the Baltics. And as a general rule, when this is going up, that's inflationary. When it's going down, that's deflationary. And after chopping sideways for most of 2024, we're actually starting to break to the downside with this index. Then what does the market think? And this is in inflation's expectations, an actual ETF that you can get into. And it's coming down after it had been going up, but we're not really seeing the expectations for inflation really increasing right now. Then we look at some other markets just to see what's going on out there. First of all, we look at aluminum, which is in an uptrend, pulling back to its 50-day moving average. Corn is also in a downtrend, so that's not inflationary there. Wheat is in a downtrend as well. Fertilizer, not really moving up too much right now. That's not really inflationary either. And we watch oil for a number of different reasons, but lately it's been more geopolitical. And you got the Middle East pretty much on fire right now, a ceasefire that lasted about 15 minutes, but oil continues to go down and is in a downtrend right now. Then we look at a ratio between gold and oil. Now, gold's been under some pressure lately. Oil's been not doing very much, so we've been pretty much going sideways with this ratio. And we look at a correlation between oil, which is the red dashed line where it's been coming down, and the 10-year yield. That's also been coming down. And we're seeing that the relationship between the two is pretty strong right now. That means they're usually going up or down together. Then here's gas, which is in a downtrend. And then we look at diesel, which also has been going down for the most part. Heating oil, which has also been going down. Natural gas, which is actually starting to try an uptrend here. And copper, which is kind of all over the place, but it's actually more in a downtrend. And we use this as a barometer of the economy. And typically, when things are looking bright for the economy, copper will go up. The fact that it's going down and actually has a recent death cross here, that's a little bit of a concern to us. This market is anticipating economic weakness going forward. Now, that could always change, but we keep an eye on this anyway. And we look at a ratio between copper and gold, where copper has been underperforming gold. Then a longer term copper to gold chart here, and also plotting the 10-year yield and the 2-year yield. And they're tending to come down in the most recent readings here with the green line and the red line. And we're also actually coming back up a little bit. We're seeing a real disconnect here between this ratio and the yields, where they typically move in the same direction. And even though they're on different scales, they tend to not get too far apart. but they've been far apart and moving in opposite direction now for the last couple of years. Gold falling back a little bit under its 50-day moving average. Silver is also under its 50-day moving average. And we look at the closing price for gold, the closing price for silver, and really it's kind of going against logic here. They're actually working their way down to a neutral reading with the correlation, where typically you would think silver and gold tend to move more in tandem with each other, and most of the time that's the case. Right now we're seeing a bit of a disconnect between that relationship. Then we look at a gold to silver ratio on top, and then we plot it with the dollar index in the middle, also coming down and giving us almost a neutral reading. So we're not really getting any insight from this chart. The dollar has just started to go back into an uptrend now, and we're also in an uptrend on the weekly chart. And we look at the euro, which has really been pulling back against the dollar and comparing that with the dollar index. Also, the Japanese yen has been going down, but bouncing back up recently against the dollar. Then I break them out, and we're actually seeing a downtrend now of the euro compared to the dollar. It had really been falling. It's now starting to come back up, but this was enough to give us a death cross. So now the euro is actually in a downtrend compared to the dollar. The Japanese yen is still hanging on to an uptrend here. It had really been coming down after going up to give us that uptrend. We'll have to see if this generates a death cross as well from the yen to the dollar. And then the British pound also coming back up recently, but it had really been seeing some weakness. If we stay underneath both the blue line and the red line, we'll eventually see a death cross here. Then some different index ratios, and I've been pointing this out in the daily video where we're continuing to go up with the weighted version of the S&P, but we're going down now with the equal weight version of the S&P. And that just means the really big stocks are really driving the index right now. We look at a ratio between the two. When this is going down the way it has been lately, that means that the equal weight is underperforming the S&P itself. Then we look at a ratio between stocks and commodities, and this continues to show, as it has for pretty much all of 2024, how stocks are outperforming commodities. Here's an inverse, also showing how commodities are underperforming stocks. Then we look at the NASDAQ 100, which has really been improving because that has the big stocks that have really been driving the indexes. We're still in a downtrend. Now, the NASDAQ 100 and the S&P just set all-time highs on Friday, and they've been setting all-time highs numerous times throughout this week. But since last summer, we've been seeing the NASDAQ 100 underperforming the S&P, even though both have been doing quite well. Well, we're seeing the NASDAQ 100 really bounce back up here. If that can continue, we would see a golden cross with this ratio, meaning that the NASDAQ 100 is outperforming the S&P 500. Then the S&P 100, after almost coming down and generating a death cross with this ratio, now we're starting to go back up. This means the bigger stocks in the S&P 500, which is the S&P 100, are now outperforming the S&P 500. The NASDAQ also setting all-time highs many times this past week. The S&P 500 also setting all-time highs. And we're starting to see the NASDAQ begin to outperform the S&P 500. So this is more tech. This could be positive if this continues. The NASDAQ 100, though, is still underperforming the NASDAQ, even though they're both coming off of all-time highs on Friday. Then we look at the mega cap, the really big stocks, and they've been just chopping sideways here when we compare it to the equal weight S&P 500, but then it really bounced up this past week. If that continues to go up, that should help the S&P to continue to go up. If we see weakness in the mega caps, that could really put some pressure on the S&P itself. Small caps doing better, but still in a downtrend when we compare it to the S&P. And here's another ratio between small caps and the S&P. That's the red line, and then the blue line is the S&P. We're seeing how they're going in opposite directions here. The big software companies looking pretty solid at this time. The robotics and AI ETF up out of the rainbow. The rainbow's going up, but still going sideways when we do a ratio between the robotics and AI ETF and the tech sector. So it's not really outperforming. Mega cap. These are the real stocks that are driving the market, and they have been for quite a while now and hitting all-time highs here and in a solid uptrend. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities taken together. And a lot of the strength we're seeing recently is the Dow because it's setting all-time highs where we've been seeing some weakness with the transports and the utilities this past week. And we look at another ratio between small caps and the tech sector, pretty much chopping sideways. Even though small caps are starting to get in an uptrend, tech has been coming on strong this past week, and small caps were actually down. Then we look at the advanced decline line, and I show this in the daily video, and we go across different indexes. And this is a little bit of a concern. We're coming down, but we're still above the moving average with the NYSE common stock. Setting an all-time high with the S&P, but coming down with the advanced decline line. Coming back down to the moving average with the mid caps, and pretty much flat, but still above the moving average with the small caps. Transports, which were looking good, setting an all-time high, now are starting to fall back. And we're seeing this ratio going up as the Dow's been going up and the transports have been going down. Now we look at another ratio between the transports and the S&P, been going sideways with this ratio. The transports started to outperform, but then after they set that all-time high, boom, over the last few sessions, they've been really underperforming. We look at the correlation between the S&P and the transports, falling off a cliff right now. They're having a tendency to go in opposite directions. The S&P has been going up as the transports have actually been going down. Low volatility. This is more defensive. Looking good when you look at it all by itself, but continuing to underperform when we compare it to the S&P. Then traditional Dow theory, just coming off of a recent all-time high with the Dow, weakness with the transports, weakness with the utilities recently. And then this is a new take on Dow theory, where instead of using the Dow, we use the S&P, setting an all-time high. We use the NASDAQ instead of the transports, setting an all-time high. We break that down. We're not quite there with an equal weight all-time high yet for the S&P, and a little bit off of an all-time high here with the QQQ equal weight. The Wilshire daily chart here, just coming back and looking like it's setting a new all-time high, a broad market measure there. Also setting a new all-time high with the total US stock ETF. The FANG index, this had been lagging for most of the late summer into fall. Now it's really starting to show some strength. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, stocks like that. This is the strongest part of the market, at least in the recent past here, this past week. But we're coming up with the FANG index to the short-term trend line. We'll see if this is going to provide some kind of overhead resistance here. ARK, since Tesla's been doing well lately, ARK's been doing well and in an uptrend there. And then we look at the all-world ETF, but we take out U.S. stocks. It came down to its 200-day moving average, been bouncing up, but has yet to get back above its 50-day moving average. And then we look at a ratio showing how U.S. stocks are still outperforming world stocks. Then here's a longer term chart. It's a monthly chart of a ratio between the S&P and international stocks, continuing to show how the U.S. is outperforming. We plot a momentum oscillator on here, also continues to go up. Then we keep an eye on bonds, where we've been going up with the 10-year based on price. And we've been going back up here with the total bond ETF based on price. And kind of chopping around, almost in danger of a death cross here, but seeing some recent strength here with the Pring World Bond Index. But when you do a comparison between bonds and stocks, this going down means that bonds are underperforming. And we're seeing that here on the daily chart. We're seeing it on the weekly chart. And we're also seeing it on a monthly chart, this is the monthly chart here, how stocks are outperforming. High yield bonds, also known as junk bonds, just coming off of setting all-time highs. Corporate bonds also coming back up above their 50-day moving average, still in a longer-term uptrend here. And we look at the ratio between junk bonds and more conservative bonds like government bonds, coming back down into the rainbow lately. Corporate bonds also still in an uptrend, saw some weakness, starting to see some improvement now. And we look at the correlation between stocks and bonds, and the correlation is fairly high. So if stocks based on price and bonds based on price, they're both generally going up or down together right now. Then we look at the 10-year yield, and I have some Fibonacci retracement levels, but we're far away. Also, 30-year yield, far away from the Fib retracement levels. This is a long-term chart where we're starting to get up into a higher area here with the 10-year yield, which would be more historically normal, where this decline that we've seen over the last 40 years, that's been more the exception rather than what we've seen historically. And we look at a ratio between stocks and the 10-year yield. Stocks are outperforming and in an uptrend compared to the 10-year yield. Then we look at bonds to stocks. When this is going down, that continues to show how bonds are underperforming stocks. Junk bonds looking pretty solid right here, setting all-time highs. And we're coming back down to the 50-day moving average with this ratio, but lately the junk bonds have been outperforming the more conservative and safer government bonds. And this is a daily chart, how we were going down with daily yields, and then the Fed came in and cut rates, and we shot back up. Figure that one out. But lately, we've been going back down with the yields here on the daily chart. Also, coming back down on the weekly chart, looking internationally at US, UK, German, and Japanese rates. Then we look at a ratio of stocks to short-term bonds based on price, showing how stocks are outperforming. We look at the S&P 1500 and compare it to short-term bonds. Stocks are still outperforming there. A broader market measure and looking at 3 to 7-year bonds, how stocks are outperforming. The tech sector continues to show some improvement. We were dangling at the high end of the rainbow, but we did see an improvement this past week. If this continues to go up, that would be more positive for the market. If this falls back down, that would be more negative for the market since tech is such a huge part of the market. Looking at volatility of bonds really coming down as prices have been going back up. Also, we're seeing the VIX, which is the volatility of stocks, really coming down. And the correlation is still pretty strong between the volatility of stocks to bonds. Then we look at a monthly chart of the 30-year bond based on price, seeing some improvement here. And then we look at a ratio of the long-term bond based on price and commodities. Still, over the last couple of years, we see how bonds are outperforming commodities. Then I go through different sectors. First, I look at just the sector itself. The first one is materials. I do this alphabetically based on the symbol. Well, we're coming back down, but still above the 200-day moving average with materials, and we're really underperforming when we compare it to the S&P. Communication, a growth area. We want to see this doing really well if we're positive on the market, and it's starting to outperform the S&P 500 in an uptrend as well. Energy, which was starting to do a lot better, but now it's been pulling back. It's under its 50-day moving average, but still above its 200-day moving average. And when you compare it to the S&P, though, it was bouncing back up, but now really beginning to underperform lately. Financials, seeing some profits this past week, but just coming off of recent highs here. And looking good when we compare it to the S&P, but seeing some weakness now. Industrials, pulling back, but still above their 50-day moving average. And kind of going sideways, but a little bit of recent weakness when compared to the S&P. The tech sector, which is in an uptrend all by itself and showing an improvement, but we're still in a downtrend when compared to the S&P. We want to see this doing better to turn more positive on tech. And we look at staples, which you look at them all by themselves, they're in a pretty solid uptrend, but when you compare them to the S&P, they are really underperforming. Real estate, which is coming back down to its 50-day moving average, seeing some recent weakness, and also underperforming, but still in an uptrend. We set an uptrend here, but then it's been coming back down ever since that time. Utilities, which are doing quite well these days, but pulling back and dropping a little bit below their 50-day moving average, and still in an uptrend when compared to the S&P, but coming down to the 200-day moving average with this ratio. And then I look at the S&P to utilities, and we've been chopping around a lot, so I haven't been showing this chart where I usually show it every day. We're not seeing a lot of conviction, but lately we have been seeing that the S&P has been outperforming utilities. If that could continue, that would still push this ratio up. And healthcare, which is more defensive and falling underneath its 200-day moving average, it came back up to the 200-day moving average and is now going back down and continues to underperform and is in a downtrend when compared to the S&P. Discretionary, this has been doing really good. Going back to August when we had that fall off the Earth Day, this has really been the best performing sector since that time. And it's really improving and in an uptrend when compared to the S&P. Semiconductors, we're concerned about this because we've seen a recent death cross here with the semiconductors themselves where the short-term moving average has dropped below the longer-term moving average. So we want to see this really improve. This is a concern that we're underneath both of these lines. And we look at energy to tech, showing how energy is underperforming tech. And growth is still outperforming bonds, which are more conservative. And we look at the 10-year yield to compare it with tech, showing how the 10-year yield is underperforming and how the tech sector is outperforming, just like we're seeing for the S&P. Discretionary really improving when compared to staples, and staples really underperforming when compared to discretionary. And we're kind of chopping sideways here with the gold to S&P ratio. Also seeing a little bit of weakness as gold has been under pressure lately, and the dollar's been holding up fairly well. The NYSE composite was down, but still coming off of a recent all-time high and in a pretty solid uptrend. We just want to keep an eye on this. High leverage loans, which I also look at to get a gauge of the economy. This is doing really well right now. And then all stocks, US and international stocks, setting an all-time high. Emerging markets in an uptrend came down to the 200-day moving average and trying to bounce off of that right now, but underperforming the US stocks. The Japanese Nikkei, which has just been chopping sideways, just a little bit under this red line, just can't seem to go anywhere right now. And then the micro caps are in an uptrend as well. Bitcoin finally went over 100,000, just kind of camped underneath 100,000 right now. And then the home builders, they're not really seeing much of a disconnect here. We compare the S&P to the home builders ETF. The correlation between the two is quite strong right now. And then we've been in a pretty solid downtrend in China, but trying to turn back up with the KST here, turning back up in the emerging markets, starting to go back into an uptrend in Europe, turning back up in Japan, and still in an uptrend here in the US. And then we look at the intermarket analysis chart where we now have stocks doing the best year to date, followed by gold. Then we have the dollar, oil, and bonds are still negative year to date. And we look at some correlations where they're having a tendency to go in opposite directions right now when we look at the S&P and the dollar. That's why we watch the dollar. If the dollar sees more weakness, that could give more support to the S&P. And the inverse of that is also true. Also, we look at a correlation between the S&P and oil, also having a tendency to go in opposite directions as the S&P has been going up and oil has been going down. Then the S&P to the 10-year yield also in opposite direction. So if interest rates are going down, that helps the S&P to go up right now. And also the same thing, not as strong of a relationship, but the tech sector to the 10-year yield. They can keep going in opposite directions. That would help the tech sector if interest rates continue to fall. And then we look at the S&P to the 2-year yield, really having a tendency to go in opposite directions. The S&P has been going up as the 2-year yield's been going down. Then we look at some long-term charts here. This is a monthly chart of the NYSE in a solid uptrend and also as measured by the Copic curve. Also looking pretty solid here on the daily chart for the NYSE. The S&P monthly chart looking pretty solid. Also the momentum oscillators going up. And then the monthly ratio here between the S&P and another global index looking really solid here. Starting to turn back up with the KST. And the KST is a long-term oscillator. And then we look at the S&P and on top here, and then the ratio between stocks to commodities down below. This is longer term, showing how stocks are still continuing to outperform. Then at the very end, I look at the positive things, and we have quite a long list here. When you look at growth and value by themselves, and my definition of positive is when the 50-day moving average is above the 200-day moving average, which generates a golden cross. So we look at growth, value, copper, the dollar is just a new addition to the list now. And the British pound to the US dollar, even though the British pound has been pulling back, the Japanese yen to the US dollar, gold and silver are still in uptrends. The big software companies, the mega caps, the FANG index, ARK, the low volatility ETF, when you look at it by itself, staples are in an uptrend. The Dow Jones Composite Average is in an uptrend. Bonds based on price are still in an uptrend. We're a little bit concerned about the the world bond index here, because that takes some other bonds outside of the US into account. The tech sector is in an uptrend. The high leverage loans, the Dow, the NYSE Composite, and the Wilshire are in solid uptrends. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps are in an uptrend. All stocks, emerging markets, and Bitcoin just going over 100,000. and a pretty short list of what's negative, and that's when the 50-period simple moving average is below the 200-period simple moving average, the CRB index, which is really chopping sideways right now, the euro to the dollar. We'll see if any other indexes follow. And then we're concerned about the SOX index. These are the semiconductors, and they are in a downtrend. We want to see more strength from that area. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.